Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shaw, Senior Market Specialist at FXCM. My email address, rshaw@fxcm.com. Today is Wednesday, the 13th of April, 2022. I'm just going to bring up our high-risk investment warning, and just want to remind everyone it's Wednesday, so what we'll do is we'll conclude in in 15 minutes, and then we'll jump onto a separate webinar called the Crypto Minute. Everyone's obviously certainly invited to that, but I just want to keep the two webinars separate. I'm just going to bring up our market commentaries disclaimer as well. I'll keep this on screen for a few moments. Hey Zanessa, good morning to you. Lovely to have you on the webinar, and good morning to everyone that has joined. Thank you very much, and much appreciated. I'm just going to bring up our references, MarketScope 2.0, cnbc.com and tradingview.com. Let's just bring up the 10-year, and then we're going to go through to the CNBC morning notes. Just a few things there that I want to read to you guys. Hey Anna, Raj, nice to have you guys on the webinar as always. Just taking a look at the US 10-year. So we're still overbought on the daily. Okay, so there's still some room for moderation here, and if we just go through to the weekly, well, the weekly still due to clear. I just wanted to highlight that it's very much in line with the discussion we had yesterday. Is I think a lot of this inflation has been priced in, and I think there is a case to be made for shorts to start taking profits off of the table, start to book their profits. And yesterday, when the inflation numbers came out, there was a certain moderation. So you can see a red candle, and I think that did confuse a lot of market participants. I've seen all types of explanations for it. Hey, no worries, understood. Hey, Michael, nice to have you guys on the webinar. But so one of the explanations is that whilst the headline inflation numbers are high, core inflation looks to be moderating, and that certainly may be the case. Nevertheless, my preferred sort of stand on the matter is I think a lot of it was priced in. Markets are efficient. Okay, academic studies seem to suggest that markets are what we call semi-strong form efficient. And I would admit that it's a very hot topic. There's a larger debate around it, and you kind of choose which side you're on, and then you'll defend it. But my opinion is, we are fairly efficient in the market, and that a lot of the inflation was priced in. We knew a week ago that March's inflation is going to be a blowout figure. We knew it. So why wouldn't we act on it a week ago? So just wanted to, so we want to keep an eye on this. Effectively, the higher rates are coming, and but markets don't move in a straight line. So some sort of moderation here, I think, would be sort of sensible. In terms of why would we get higher rates here, what's the mechanism? Again, we touched on it yesterday, quantitative tightening. What is quantitative tightening? Well, we've got $9 trillion sitting on the Fed's balance sheet that has been pumped into the economy. The Fed's now going to start normalizing the balance sheet. How are you going to normalize the assets that you've got capitalized on your balance sheet? You're going to have to sell them, right? So if you start selling en masse, what happens to pressure? So all of a sudden there's a excess supply as opposed to an excess demand. That pushes price of bonds down because of the excess supply. Theoretically, yields then increase. So that's kind of the mechanism, sort of in a sort of very straightforward way of looking at it. And we, of course, probably get that starting from the May Fed meeting. And we must also just say that the process in of itself is a huge unknown. As much as you want to as much as you want to, I guess, normalize your balance sheet, what kind of constraints will there be? And one of the constraints would be on what we call mortgage-backed securities, which are longer-term bonds, and Fed's going to be selling those at a loss. How do they manage that? Also, if they've now got a target, just by the way, their target is, I believe it's 35 trillion of mortgage-backed securities, 60 trillion of just sort of your treasury notes. So in total, they're looking at 95 billion per month, but 35 billion in terms of the longer term bonds. So think about this, okay? If the pressure is pushing prices down, if the pressure is pushing prices down, well, the volumes are going to have to adjust to hit your target of 35 billion. I mean, there's certainly a lot of management that has to go into this. So what happens if 35 billion is more than the market can handle? What happens if it's too much, you know, considering that prices are starting to be suppressed? All of these things have to be taken into account. So sort of a soapbox moment there, but I guess I just started talking and couldn't stop. Let's go through the let's just go through the European market report here, and it reads as follows. European stocks are set for muted open after US inflation data, ECB meeting on the horizon. The ECB meeting's tomorrow. Okay, it's tomorrow. London, I think European markets are set for a cautious open on Wednesday as investors digest a key inflation print from the US and look ahead to Thursday's European Central Bank meeting. US consumer prices rose by 8.5% in March from the previous year, the highest level since 1981, further fueling concerns of tighter monetary policy from the Federal Reserve. Core CPI rose 0.3%, slightly below expectations. That's actually new to me. I thought we hit the expectation of 0.5, so maybe a different. Maybe I read the wrong core number there, but this is from CNBC. US stock futures advanced in early pre-market trading, with traders hoping that March may have shown a peak in inflation after major indexes gave up on early rally to close in the red on Thursday. Shares in Asia Pacific were mostly higher on Wednesday after Chinese exports rose more than expected in March, while New Zealand also hiked its main interest rate, and this was a surprise. So they hiked by 50 basis points as opposed to an expectation of 25, and that's its biggest increase in more than 20 years. Back in Europe, market focus is attuned to the ECB's monetary policy decision tomorrow, and that as the Governing Council balances slowing growth and record high inflation, increasing the risks of stagflation. Our base case is that ECB policy will remain unchanged at this week's meeting, with details on the end to quantitative easing being unveiled, says a macro strategist for Goldman Sachs, Gurpreet Gill. An end to the asset purchase program has already been signaled for the third quarter, so the focus on Thursday will be on any changes to that timeline. A sooner conclusion to QE would open the door to earlier rate hikes. Okay, so we just be very careful there. We're talking about the ECB, the Fed's QT that's due to start in May. The ECB is only looking to end the QE, not T, QE in the third quarter. So there is a big lag there between the central banks. The World Trade Organization on Tuesday slashed its forecast for global trade. Slashed its forecast for global trade growth this year to 3% from 4.7% because of the double whammy caused by the Russia-Ukraine war and COVID-19, and warned that soaring prices could facilitate a food crisis. UK intelligence has suggested that Russian forces are readying a large and more focused push to expand control of eastern Ukraine, while the British Foreign Secretary said on Thursday that the government is working to verify details on an alleged chemical weapons attack in the Ukrainian city of Mariupol. On the data front, UK inflation came in at an annual 7% in March, its highest since for 30 years. So that's huge. UK inflation at 7%. Consumer prices rose by 1.1% month on month, outstripping expectations for 0.7 in a poll of Reuters economists. All right, so on an annual basis, 7%. All right, did a fair amount there. Let's just see how much time we've got left. Not much. All right, let's bring up some charts. Okay, so this is the DAX. You can see that this bear market rally scenario still very much intact. What we want to look for is just signs of some support here. Now, I think that if there is any support here, it's sort of short-term support. I do think the pressure is still on risk markets, but if the yields start moderating, and we're just using the US 10-year as a sort of a proxy, but you can see that there is scope for a normalization there. It probably offers some sort of support to risk markets. Now, having said that, let's just do let's call it a swing analysis. So what's a swing analysis? Let's just analyze this swing here, and there's no doubt this is a swing of weakness. How do I know that? Well, you just take a look at the highs and the lows of these three candles. So each candle's got a lower high, each candle has got a lower low. So in other words, new lows are being made on a weekly basis. We just want to keep just an eye on that yield. Just an eye on that yield. Again, I think there's scope for some sort of moderation there. It is overbought, and if there's moderation on the yield, I think it does flow through to other parts of the market. Let's just take a quick look at the US dollar as well. Okay, US dollar is on a tear at the moment, so you can see again, just like we looked at the last three candles of the DAX. Take a look at the last three weekly candles of the US dollar. What have we got here? Three candles of higher highs, three candles of higher lows. So the swing for the dollar is up. Okay, what's the danger here? This guy. Okay, so certainly dollar is looking very strong, but we are getting to an area of excess. So that to me seems to suggest, well, the excess on the yield markets just reinforced. And so if the yield does normalize, then we may see some sort of normalization in the US dollar. If we get that normalization in the US dollar, it's probably a good dip to see if we can exploit, okay, because we're in an uptrend here. So just keep an eye on that. I just want to take a look at oil as well before we go through to the crypto minute. And again, this is a very important chart in terms of the inflation print that we got yesterday. Headline inflation was a blowout number, came in at 8.5. I got core at 6.5, which I sort of in my sort of research was what was forecast. Today CNBC says core was a slight miss. Nevertheless, the point of the matter is that headline is obviously way more than core. What does headline incorporate that core strips out? So oil is obviously, energy prices is a big factor. So we want to just keep an eye on this to see if there's some sort of moderation or not. In fact, we can bring in a few other symbols here just before we move to the crypto minute. So let's just take out this one and this one for now. And let's just add in wheat. And let's add in natural gas as well. All right, so let's just take a look at wheat. Okay, so there has been a moderation in wheat. What we want to do now is keep an eye on prices, because we'll use this as a proxy for food inflation. Okay, food inflation is stripped out of the headline to make up core, energy and food prices. So we've got this kind of tension here. Is this going to be a higher trough, or is this going to be a lower peak? So there's the tension right there. Now, a moderation in oil, a moderation in wheat prices would actually be really good for monetary policy. Let's just go through to natural gas as well, just as the last chart. All right, so this is a large portion of where the inflation is coming from as well. And well, this looks like it's just this just looks like it's on track for higher prices. Okay, so basically we want to look at oil prices, we want to look at wheat as a proxy for food, we want to look at natural gas, and the idea here, of course, is even if the core comes down, but the headline stays up because of the volatile items that are stripped out, well, central banks tend to focus on core. They don't really focus on headline. But if headline's not moderating and core is moderating, again, there's scope there for some policy errors. So we'll just keep an eye on that. Lisa just asking for the link for the crypto. Yeah, I'm going to send that out now. Okay, I'm just going to send that in the chat, and then there's just one question here from Anna, and then we'll end off on that, and we'll continue the discussion in the next webinar. Lisa, did you get that? I've sent it through. Did you get that? I'll just resend it again. Okay, cool. Anna just saying, but what about wheat? We know there's going to be shortages because of the war. Okay, that may very well be the case. That may very well be the case. Well, that's bad news, isn't it, Anna? Because then we probably can get rid of this guy and see this move up here. So the idea here is perhaps this was a little bit overdone, this leg here. Technically speaking, you can see it was overdone. Okay, so there's some sort of moderation. The fact that we've moderated here, and the fact that there is now a sort of inference that the war is going to hit wheat prices, well, that's not a good that's not good news, because it, again, that contributes to that supply shock we've been talking about. That makes monetary policy much more difficult. And so there is no, so Anna, your question's a good question, but I don't think there's an answer to it. I think this is what policymakers are grappling with at the moment. And to be fair to your point, you know, I was just watching Bloomberg this morning, and the situation in the Ukraine certainly doesn't look to be getting better. If anything, it's looking to get worse. And we just read on the CNBC that you know, English intelligence is now looking at a whole new intensification on the east. You know, it's just we certainly not we certainly haven't seen the end of this. No, it doesn't. Strong oil, strong wheat should mean strong CAD. Let me ponder that. I'm going to, this would be the absolute last, and then we're going to, and we must go into the crypto minute. So this is the US dollar to the CAD. We're looking at the weekly basis here. I think that what you are saying, Rob, has merit. You can see that if we have to say, well, what's going on here? Let's say equilibrium, some sort of parity that is being, there's oscillation around it. So there's oscillation around, you know, what is considered sort of a fair price for US dollar CAD. But then you take a look at, say, Euro US dollar. It's a different story. You can see Euro is showing much stronger capitulation against the US dollar. Let's just take a look at the pound. Okay, pound showing capitulation against the US dollar. Let's just bring in here Euro CAD. I'll just take Euro out there. So I need to put that back. Let me just put the US dollar CAD in here. Sorry, Euro CAD. Close it, and I think, Rob, you'll get exactly what you're saying, right? Should get the Euro capitulating against the Canadian, because the Canadian is showing strength. Why is the Canadian showing strength? Certainly because of the fact that it's a commodity currency. So I think you're quite right. But I wouldn't say that it's a sort of a runaway currency against the US dollar. US dollar is also, there's strong support here on a monetary policy side, Rob. So yeah, CAD is certainly right up there, but always match that relative weakness with that relative strength. Yeah, Solomon's just saying Egypt has only 2 months supply of wheat and has relied heavily on Russia and Ukraine. It's starting to look to India for supplies. A lot of African countries have also relied on wheat from the same sources. Yes, so that's a huge point that Solomon's making. So when you're looking at CPR baskets, every country's CPR basket has a different component to it. When you start looking at African countries, a large component of their CPR would be influenced by the wheat shortages. So there could be huge inflation problems in Africa, Solomon. Quite correct. All right, I'm going to end it here. We're 8 minutes after the hour up. Please excuse sort of the abrupt ending, but we're going to jump through to the crypto minute. We'll carry on our discussion there. Thank you very much for joining this morning. I'll see you in the crypto minute. Thanks, guys.